By the way, Roblox earnings also are now out. Let's get to Steve Kovach with those. Hey, Steve.
Hey, Mike. Yeah, shares falling about 10% now after hours, after a big loss here on the top and bottom lines. Let's see, 30 cents loss versus 21 cents expected, a big miss there. Revenue also a miss, 640 million versus 644 million expected. Revenue growth, now that's up 21% year over year, but growth there is still slowing, Mike. This is going to hurt some things here. Daily active users, 52.2 million. Now that's up 21% from a year ago, but again, slowing growth rates. It's really hard pandemic comps keep hurting the company here. Growth there is about a million short there on users from what the street was looking for, but users are down versus last quarter. That's a sign kids going out in the real world and not exactly in the metaverse. By the way, I spoke with Chief Business Officer Craig Donato on these results. He's telling me they're working through these tough comparisons from COVID, adding, quote, as we move forward, we're not just simply retaining those users. We grew on top of that. That was a fairly substantial number to actually have go to 26% year over year in July. So look, here they're trying to point to growth now in the current quarter as they're coming out of these tough pandemic comps, Mike. By the way, call tomorrow morning at 8:30 a.m. One thing you should be listening for is hints from CEO Dave Baszucki on their advertising plans. That's going to be a big initiative for them through the end of the year, Mike.
All right, Steve, thanks. Yeah, Roblox seemingly not immune to this sort of video gaming malaise we've seen wash through the industry. Let's bring in CNBC contributor Bryn Talkington of Requisite Capital Management. She owns Roblox, as well as Keith Lerner of Truist Advisory Services. Bryn, good to have you on to weigh in here with the Roblox story. Stock already down by 2/3, been a volatile one, also doubled off the lows. Earnings in general, better than feared, but it looks like we have some bumps in the latest little run the last couple of days. What's your read early on Roblox?
Yeah, well, I think, first of all, today is probably not the best day as small caps definitely are turning over, the NASDAQ's turning over. And I think sentiment for these high growth companies that have revenues, have some free cash flow, but no earnings, they're going to be tough comps, especially a tough day, especially on today. I do think what investors should look at is, as I'm reading the report as well, is that, that average booking per daily average user, year over year, it was $12.25 per user. That's down 21% year over year, but still growing long term. And so I do think, as you guys just previously said, these comps year over year are really tough because everybody's out about in the summer. So I think summer comps are really tough. But once again, the stock is one of the very few stocks that's up well over 100% off its lows. So if it can actually open tomorrow, after the call tomorrow morning and only be off 5 or 10%, I still think that's a win for Roblox shareholders because it has had really an amazing run since that June 16th low.
Yeah, and not to mention how aggressively it opened on its debut publicly. It had a lot of high expectations set when that came out. Keith, talk just in general about your approach right here to the recent rebound we've seen, whether it can really amount to an all clear for the market. Do you think June was the low? How would investors be kind of reallocating according to what the market's given us here?
Yeah, sure thing, Mike, and great to see you, great to be with you. Our point of view has actually shifted. Around the June lows, we were saying that this market was extremely oversold on many metrics. And more recently, we've been saying to our investors that we think this is a more opportune time to at least trim back on equities. Because at this point, with this rally, we think the upside is probably capped, 42 to 4,300. We look at a confluence of technical and valuation levels, and the risk reward, in our view, is just not that favorable. Because you look back before the pandemic, this market for the last 20 years had a hard time sustaining an 18 multiple. We're at 17.5 today, so we don't think there's a lot of upside there. And we do think there's some earning risk. Even if you don't think there's earning risk, you're still pretty fully valued. And the other thing, Mike, that I think is really important that I keep staring at is we have the most central bank tightening globally we've seen in about 30 years. That's going to impact the market and the economy. And again, from our point of view at this time, we're a bit more cautious short term.